Assalamualaikum warahmatullahi wabarakatuh. My name is NUSRATINA bint HASMIZI. I will represent exercise 1 for question 1, 2, 3. Okay, so first question as to define financial management. Financial management can be defined as managerial finance. It provides maximum benefit to the owners or the stockholders by managing firm resources to its full potential. Other than that, financial management also focuses on accumulation and allocation of scarce resources so that they can generate revenues. Besides that, it also indicates concept of wealth maximization. This question asks to explain 3 common goals of firms. The first common goals of firm is maximization of profits. Profit maximization is important as it is able to provide stability and growth in operations. Besides that, it also can be a reward to the individual or the institution after contributing in the firm's effort to be a successful company. The second common goal is maximization of sale. The level of effort to get maximization of sale must in line with the effort to get the maximization of profit. Therefore, to be clear, high sales means that the firm has the good control on the market. Lastly, we have minimization of risk. To achieve this goal, firms should only be venture in the activities that offer more profit than risk. This is because risk only be a barrier to the management to get a maximization of profit. This is the functions of the financial manager. Firstly, forecasting and planning. Forecasting and planning is a guidance to ensure the growth and future viability of the firm is in line with its goal. This is because every future decision has its own outcome, whether it is good or bad. Therefore, it is essential to forecast the outcome and come out with a good plan to overcome any problems. Next, we have investment decision. The investment decision also will have impact on the firm's size, growth, and profitability. It will determine the level of business risk as the company will be involved in variety of business activities. The next financial manager's function is financing decision. The firm's financial structure will be determined by the financing decision, which will support the firm's need by accumulating funds through a desirable combination of debt and equity. Therefore, it will determine the level of financing costs, which will affect the firm's potential returns. Lastly, dealing with the financial market. The financial managers must deal with the money market and capital markets, either for financing or investment purposes. This is important because both investment and finance decisions can have an impact on the firm's risk and return as they are controlled by management and perceived by market participants.
Hi, Assalamualaikum. I am NURFARINA binti GHAZALI and I'm going to continue the next theory part of financial analysis. I'm going to talk about the functions of financial systems. Financial system moves scarce funds in the form of credit from a saver to those who borrow for consumption and investment. It allocates financial resources in the economy by transferring and fund from those who have surplus and are willing to invest to those who need money, and the cost of funds or interest mechanism will adjust the supply and demand for funds in the market. Next, the differences between money market and capital market. Money market provides trading facilities for investors, either with temporary surpluses or shortage. It is also deals with marketable securities or money market instruments that mature within 1 year or less. As for capital market, it is an important channel for businesses to raise capital to fund their growth and expansions. Capital market deal with transaction for long-term securities. And lastly, the differences between primary market and secondary market. Primary market is the part of the capital market and deals with newly issued securities or initial sale that involve the issuer and the first investors. As for secondary market, it deals with securities previously issued that the existing securities are bought and sold here. I will pass to the next presenter for calculation part.
Assalamualaikum warahmatullahi wabarakatuh. My name is HAZIQAH binti HANIFAN and I'm going to present for question number 4, which is number 1, number 2 and number 3. So for the first question is define risk and return. So the meaning of risk is it is defined as the possibility that the real profits from a result or investment may differ from the expected outcome or return. In other words, the chance of losing some or all of one's initial investment is risk. For the second one, the meaning of return is the amount of money gained or lost on an investment over a period of time. The change in the cash worth of an investment over time can be described formally as a return. A return can also be calculated as percentage based on the profit to investment ratio. Returns can be given as net result, which is after fees, taxes, and inflation, or as gross return, which is without adjusting for inflation. Moving on to the next question, which is state the basic rule of the relationship between the risk and return. So, the relationship between risk and return is the greater the investment's potential return, the greater the risk will be. So for the last question, it stated that define systematic risk, list and explain 3 types of systematic risk. So the systematic risk refers to non-diversifiable risk that cannot be removed regardless of the numbers of securities in an investing portfolio. These dangers exist both inside and outside of the organization and are beyond the finance manager's direct control. When it comes to non-diversifiable risk, stocks often do not have the same level of non-diversifiable risk as other investments since it is based on the unpredictability of the securities return in relation to market returns. Beta coefficients are used to determine the degree of systematic risk. There are 3 types of systematic risk, which are market risk, interest rate risk, and purchasing power risk. So for the first one is market risk. The meaning of market risk arises from investors' expectations about the price of a company's securities in the market, or from customers' expectations about the price of a company's product in the market. For example, if an investor believes that the price of a company's stock will rise in the near future, they will buy the stock today in anticipation of a higher price. So, for the second one is interest rate risk. Interest rate risk is the price mechanism for supply and demand for money in the market. Any variation or shift in the rate poses a significant threat to both investors and businesses. Higher interest rates will raise interest expenditure, reducing the company's profit and the value of the return obtained by investors. Last but not least is purchasing power risk. Purchasing power risk is linked to rising inflation, which means that customers' purchasing power will erode if prices rise quickly. It will result in fewer sales and earnings for the firm, particularly for those dealing with non-durable items. However, compared to luxury good makers, the impact on enterprises that create essential needs, products such as groceries, beverages, and textiles will be smaller. That's all from me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is HARISHA binti SAIDON HADZRI. I will present question 4, which is define unsystematic risk and 3 types of unsystematic risk. Unsystematic risk is a divisible risk that is exclusive to a single business. These are problems that arise within or inside the organization, and so are under the responsibility of the financial management. Risks cannot be removed, but they may be lowered to some extent with the right mix of asset in investment portfolio. 3 types of unsystematic risk. The first one is business risk. Business risk is the problem caused by the company asset being mismanaged. A typical business could include multiple departments such as people, marketing, production, and many more. All of these divisions must be able to work together in order for the organization to fulfill its stated goal. Failure to manage any of the company assets or division will result in reduced performance and, as a result, lesser profitability. For example, if the production department management is inept, the company output will suffer. This result in decreased sales and, as a result, lesser earnings. The second is financial risk. Financial risk is caused by the company usage of an ineffective funding means to fund in investment operation. For example, if a company relies too heavily on debt, it will have to pay a high interest rate, increasing the risk of insolvency. Investors consider a firm to be very hazardous if it has too many fixed commitments for principal and interest payment on debt. This will make it harder for the corporation to seek further financing from other sources in the future. The last one is Operational risk. Operational risk are terms that describe the risks, uncertainties that an organization encounters when doing day-to-day business activity in a certain area or industry. It is a sort of company risk that can occur as a result of failure in internal procedure, people, or system.
Assalamualaikum warahmatullahi wabarakatuh. My name is Puteri Nurintan SHAHIRA binti ZARIZI. Today I'm going to present about the risk and return. So the question is, a solar LTD plans to invest in a new plant that could provide the following returns for a given state of economy. So we have three states of economy, which is boom, normal, and recession. From the question above, we have obtained the expected value for project C, which is 34%, and expected value for project D is 26.50%. Next, for the variance for project C, we have 304, and the variance for project D is 255.25. As for the standard deviation for project C, we have 17.44, and the standard deviation for project D we have 15.98. And lastly, for the coefficient of variation of project C we have 0.5129, and the coefficient of variation of project D we have 0.6030. Based on the calculation that we have done, we have found that Project C is lower risk than Project D because the coefficient of variation Project C is lower than the Project D. In conclusion, Project C will be accepted.